Well, we're back talking finances today again with Gavin Martin from Cornerstone Wealth and talking about buying property and a low interest rates market. Gavin, welcome back to 2020.
Well, g'day Neil, great to be with you again.
Well, Gavin, it was just recently we were talking about whether this is a good time to buy because with a low interest rate environment, in some places it's actually cheaper to buy than rent. And we did beg the question last time we spoke about whether, in fact, it's a good time to buy an investment property. And that opened a whole new focus and a new dimension to when we talk about buying a house. Is this a good time to buy an investment property?
Yeah, it's a very good question, and similar to buying your first home, it really gets down to your personal situation. Is it a good time for you to buy an investment property? And that's the question that we should ask if we're thinking about going down this track. But the good thing about, or the unique thing about property is it's both income nature and it's capital gain. So you're generating both rental income from it, but you can also see the value of the property go up in value, and therefore it's less risky than, say, shares, but it's a little bit more secure than shares, but it's got a little bit more return than term deposits, for example. So it sort of sits in the risk spectrum between those two investments, and that's the beauty of property. It's got its unique characteristics that it can work well for people.
Most people agree that in the current circumstance, there is a slump in property, and it's likely to continue on for some time. I guess the big factor is how long a slump in property will last.
Yes, the question that if we could answer, then we'd be able to make lots of smart decisions. So because we don't know what's going to happen in the future and how long it's going to take for the property market to take off, and it really gets down to areas. So some areas I know in Melbourne have really gone up in the last 6 months. They've really taken off, 10% in the last 10 months. So last 6 months. So it really gets down to unique areas. I know there's some of the mining towns might be laying off employees. In a property in that area is probably not going to be bubbling along. It might be coming back a little bit. So one key thing is that often way you make your money is on the purchase price. So doing your research, regardless of what the climate is, purchasing well is important, particularly with those investment properties. And
so when the real estate marketer says position, that's an important aspect, obviously, of buying any sort of property, and particularly an investment property, because you're buying an investment property for the possibility of reselling it sometime soon at a profit. Yes,
exactly. You might have the right position, and that's great, but if you buy it at a price that's inflated, then you're going to take a while to recoup the money that you've paid out, particularly when you're including the likes of stamp duty. So property is a high entry and high exit cost because of the stamp duty and sales cost. So you need to really think about property as a long-term investment, and if we've got low prices at the moment, or relatively low prices at the moment, you don't get into property generally to sell in 12 months' time. I know people do that flipping process and they can make it work well if they renovate and that sort of thing, but if you're looking for investment purposes only, then you really need to be thinking around the 5 to 7 year period, and during that sort of time frame you're likely to see the valuations of property go up.
If you're trying to do the right thing and buy a property at the right value, there are some resources, some tools around to be able to confirm what a property is likely to be valued at. Any insights into that area?
Yes, the key is understanding your market, and you can use those reports to, supplement your own knowledge, and you can use buyers advocates who are specialists in understanding what your needs are and what properties are well worthwhile. You basically pay those people a fee. But I love the approach of really doing your own research, understanding what properties sold for. I know in Victoria you can go to the Real Estate Institute of Victoria website every weekend, and you can see most of the sales that happened that weekend, and you can keep tabs on exactly what houses are selling for, and you can really get a sense of what the market is and what's good value for money at that particular point in time.
And Gavin, buying an investment property, is it more in the past now that it was a big tax advantage having a investment property than it is at the present time. How does it work when it comes to taxation?
As the tax thresholds have come back, so the highest marginal tax rate used to kick in a lot lower than it did before, but now you need to earn over $180,000 to be paying 46.5% in tax. That used to be under $100,000. And so as those thresholds increase, the advantages of what we call negatively gearing, as in paying more money out for holding the investment than we're getting in, that scenario has a less advantage. So the lower your tax rate, the less advantage there is in negatively gearing. And therefore the less advantage there is in often to invest in property. But if you have the approach that you're going to actually either break even or have positive cash flow on the investment, then that's a good approach. And some property people have that as their focus. Their positive cash flow investment, and that's all they focus on, making sure that they're always going to make money from day dot, rather than the capital growth real estate people. They're focusing on, I don't care whether I'm going backwards in terms of the money I'm paying out here. I know that the value of this property is going to go up over time, and so that's what they focus on. So there's two main schools of thought with property.
And of course, another dimension altogether, of course, people with self-managed superannuation funds are also property investors as well. And is that a growing type of an industry, people who are into self-managed super?
Yes, it is. So one of the key changes a couple of years ago was that you're able to borrow to invest within your superannuation fund. And if you've got a self-managed super fund, that means you can borrow to invest in property. That attributed to a lot of the growth a number of years ago in property markets, because people were able to then borrow money and invest through their superannuation fund. But you've raised a key issue. The thing that you need to do before you invest in property is decide which structure to invest in. You could invest in your own name, you could invest in joint names, you could invest through a trust, a company, or in your superannuation fund. And so the key question there is, what's the best approach for you? If you're investing in positive cash flow and you don't want to ever live in it, then your self-managed super fund can be quite effective. But if it's going to be negatively geared and you've got a high marginal tax rate, then investing in your own name can be a better option. So you need to weigh up all those things and decide which structure to invest in before you actually go and invest in the property.
Well, Gavin Martin, always good to get your insights into these financial issues. And I guess in summing up what you said earlier on, it might be a good time to buy. Is it a good time to buy for you? And I guess each individual needs to make that sort of assessment. Not always easy to do on your own. And that's why people like you, Gavin Martin, exist. I'll point people to your website at www.cornerstonewealth.com.au. And of course, the types of things we've been talking about have been general in nature. And if there are personal circumstances that need to be taken into account, a good thing to talk to your financial advisor. Gavin, it's good talking. Thanks for being with us again today on 2020.
Thank you, Neil. Great to be with you.